Welcome to the Motley Fool's Crunch Time series, where we scout out a single company from their story to their opportunities and risks. Today, I'm covering Plug Power, the hydrogen company. And let's start with the company's business strategy. At its core, Plug Power makes hydrogen products and a bunch of different hydrogen products, starting with fuel cells. Their main business, their traditional business, is fuel cells for materials handling. In other words, retrofitting forklifts to run on fuel cells or hydrogen instead of batteries. They also deliver hydrogen to customers and have gotten into the electrolysis business. Electrolysis is the process of turning water and electricity into hydrogen. That's how you can create green hydrogen or hydrogen from renewable energy sources. They also have a maintenance and services business that's related to the equipment that they've sold. So this is a growth company, and those growth opportunities emerge because hydrogen can be a cleaner source of energy and a more abundant source of energy than traditional fossil fuels. It can be produced with no inputs other than water and electricity from a solar panel or a wind turbine. As the cost of renewable energy goes lower, it becomes more economical to create that green hydrogen and makes it more competitive with traditional fossil fuels. At least that's the theory. But that's where we get to Plug Power's risks. Plug Power has been a long-term growth story and has built a bigger and bigger business on hydrogen fuel cells and now electrolysis, but it's never been profitable. And the business is starting to deteriorate. That's a big reason the stock is down over the past year. Revenue fell 29% in 2024 to $628 million. Gross margin was also a negative 99%. So they're not making money on any of the segments of their business. And that's the fundamental question that the market has about this company. Are they ever going to be able to turn a profit? When you're losing money at that rate, you need continuing sources of capital. That's why in March, the company announced a $280 million plan to raise capital. They could add another 185 million shares, continuing a long history of dilution for Plug Power. So most of the risks for the company simply come down to operations. Are those operations going to ever get to profitability? Is the growth the company has demonstrated over the past decade plus ever going to turn into profitability? We have not seen that, and that's ultimately led to the dilution that you see in shares, and that's fundamentally the biggest risk for investors. So my prediction, it's easy to be captivated by the potential of hydrogen energy, but the reality is that Plug Power has a long history of losses and dilution, and it doesn't look like anything is going to stop that in the near future. Until management shows the ability to sell equipment and hydrogen profitably, this is a stock that I think will continue to go lower, although it has been extremely volatile over the past 10 to 15 years. There may be fits and starts short term, but long term, the trajectory is clearly lower for the company's operations. So to recap, Plug Power is a leader in hydrogen, and hydrogen is a growth business globally. This has been a popular stock among investors, especially since skyrocketing during the pandemic, but the fundamentals just don't match the hype. And until the company proves it can build a profitable business and stop diluting shareholders, I think this is a stock to avoid. Now at the Motley Fool, your comments make us smarter. So please comment with your own research and insights about Plug Power and tell us what you want to see Crunch Time tackle next. And of course, check out fool.com/invest to get the top 10 stocks to buy right now. Thanks for watching, everybody. We'll see you here next time.